All right, Thursday, Coffee Talk with Christelle on my live on Facebook. As I was mentioning, I was coming to share information about the Fed, but also some DSCR talk today and just investment in general. We're going to do like a Q&A session today. It just was just a black coffee today with one of my mugs. It's actually pretty cool. You can go ahead and click this and put it on your purse. Anyways, I just thought it was cute. But the most important part is part of Joshua Tree in California. Amazing energy there. Very potent energy. So my first sip of coffee as we start, or second sip, gathering our thoughts because we're talking about just a quick, everybody's talking about the Federal Reserve decision. They paused rates. But here's the real question most people are asking me. And I apologize, going to start this over because I forgot to hit record. There you go. So everyone's talking about the Federal Reserve decision, the pause rates. But here's the real question most people are asking me. If the Fed didn't cut rates, does that mean mortgage rates won't go down either? And here's where it gets interesting. The Fed, as a reminder, does not directly control mortgage rates. Let me say that again. The Fed sets short-term rates, so it does have an impact more on your HELOC, but the mortgage rates are based on long-term bonds. So what actually moves mortgage rates? It's the bond market, specifically something called mortgage-backed securities. So think of it like this. When investors feel confident, they move money into stocks. When they feel cautious, they move money into bonds. And when money flows into bonds, mortgage rates tend to improve. So even though the Fed paused, mortgage rates could still move up or down. It all depends on inflation data, job reports, global uncertainty, and investor behavior. So when someone says, I'm waiting for the Fed to cut rates before I buy or before I refinance, what they're really saying is, I'm waiting for something that doesn't directly control the outcome I care about. So if you're saying I'm waiting for the Feds to do something up or down, you're waiting on something that you really do not have control over, but it's not really directly controlled by the Feds. So let me ask you this. If the mortgage rates improve slightly before the Fed ever made a move, would you want to be ready to take advantage of that? Or would you just stay still? Just because you're watching the Fed doesn't mean this is the right move for you. Sometimes they say, don't watch the news. Make a decision based on where you are and what you need right now. You might be renting right now. It may be the perfect time for you to purchase your first home. You might be in your home that you own, but your family size has increased and you guys need to change. It might be the right time. So don't just watch the headlines. Sometimes avoid watching them because the opportunities might be slipping because people don't focus on the fact that a lot of sellers right now are paying for closing costs. There are refinance strategies that can be done even if the rates right now are in the, let's say, high fives or sixes. You can refinance, but you're getting the house at the price that it is right now with negotiation. You can see home price improvements when you look online. And for investors, this may be a great opportunity right now because there are deals being made. People are starting to sell. People are having financial difficulty. There are trillions of debts, credit cards. So people, excuse me, are looking for opportunities. So if this helped you understand how this really works, just comment rates, and I'll break down in futures how to best help you with this. Don't just wait for the Feds. Make the move based on your family decision needed now. It might also mean now is not the right time for you. I'm not saying it's for everyone, but don't freeze because of something outside of your control. Get the information. All right. This is just our quick about updates on markets and the Feds. One moment as we remove this background and just go into our, how do you call it, our regular topics. So I'm going to invite Irene, who is going to ask the questions that we are hearing or coming up, or maybe we should be asking. So, Irene, why don't we go with the first question?
All right. So for the first question, can I buy an investment property without using my personal income?
Yes. You can buy an investment property using what's called the property cash flow. It is the DSCR loan. Just remember DSCR. And the way it works is that we'll take the cash flow of the property, meaning how much can you rent it for, and use 100% of that to calculate, are we at equal amount for how much the mortgage is? If we are, then we have the 1-to-1 ratio, which is great. You can go over where you're actually getting more rent and you have a positive cash flow, then it's improving your term of your loan. You can go under as well, and you still have an option. So yes, to answer your question quickly, as I said, yes. And you have opportunities, even if it's lesser than the 1-to-1 or over, you have improvements.
On to the next one. So how much rent does the property need to generate for me to qualify?
So that was basically what I just explained. So I basically go too much into detail at first. So to answer that specific question, let me just recap. Usually we're looking at 1-to-1. So if the mortgage is going to be $2,000, we want to make sure that the rent is at least $2,000. But up and down, there are options. Just know it has an impact. But we're usually looking for the 1-to-1, meaning 2,000, 2,000, 3,000, 3,000. The up and down, we can definitely work with as well. Yes. Next question.
All right. So do I need 20% down, or are there other options?
There are other options. So you can do, usually investment properties are going to be, we want 20 to 25% because it gives you better term, even for your property DSCR cash flow, your calculation. But with 15% down, you can actually purchase an investment property. And I'm referring to investment properties that are being held for rental, not the topic we're going to get into where it's a short term. That's different. So when we're doing long-term financing for DSCR to keep a property as a rental, you can do 15% down. But you don't get the best rates, right? But you do have that option. And I will add also, because I love to elaborate from the question, we also need what we call reserve, meaning whatever the monthly payment is going to be, when it's usually 3 to 6 months of that monthly payment. So keep that in mind. It's not just a down payment. You have the reserve and then closing cost. Go for it.
All right. So here's another question that comes through. Is DSCR only for long-term rentals, or can I use Airbnb income?
Yes. So you can use Airbnb. You can use long-term. The long term usually is going to give you better term because we have more certainty. But yes, Airbnb, as long as the numbers make sense, it is an option. So it's not just for the long-term lease. Yeah, great question.
All right. So what's the catch with DSCR loans?
What's the catch? Well,
Okay.
I won't call it a catch, but this is what I would say. Read the fine print specifically of the DSCR loan that you're getting. Usually, when you are getting a DSCR loan, lenders will put a prepayment penalty. And I'm a very transparent loan officer, meaning at the beginning, I will tell you and I will ask you, how long do you intend to keep this property? Because a 3-year prepayment penalty may be totally okay if your goal is this is a home that I'm keeping as a rental. A 5-year, to me, that's a long commitment for a loan with a penalty. I love commitments, but for a loan which you might have terms that are rates that are getting better, you may end up with a penalty. But then you have to go deeper because not each loan term has the same prepayment penalty. Some of them is a flat 5% prepayment penalty of the balance of the mortgage, even if you only have 1 year or 6 months left into the 3-year prepayment penalty. Then you have the other option, which is a decrease of the prepayment penalty, meaning if it's a 3-year, there's a reduction by 1% or 0.5%, depending on the investor. So it is important to understand what your prepayment penalty terms are so that you don't find yourself like, hey, I totally forgot about this. And now I'm facing that I'm selling the property and I have a payoff that is showing a penalty and I'm losing some of that return I expected. So great question, but be careful. Prepayment penalties are common, but there are fine prints to read. Another catch, is there a catch? And I'll say only a catch if you're not paying attention or you're not aware of this, to ask your lender, who may not be as transparent as I am. Another catch would be they don't necessarily tell you the reserve that are needed. And some lenders, it might be 3 years, some lenders might be 6. Some may actually ask on the other properties that you own when it comes to investment in general. But DSCR usually will be on the property that you are financing. Another potential, that's really the things that I would say to pay very much attention to. Oh, it's not a catch, but it's a great aspect of the DSCR. You can close into a business. You can close into an LLC. Okay, but when you do close an LLC, be careful when you start the process that you are confirming, okay, I have an LLC with a partner and I own a certain percentage. So they look at how much percentage. Usually you need to have at least 25%. Some lenders will require all the owners to be on the loan, and some will be just at least one who has 25%. So don't find yourself at the end of the process and like, oh, now we have an issue. Because this is an extra layer. The LLC documents have to be reviewed and approved. And I think that would be really the most that I would say as far as a catch. Thanks,
Alright.
Ari.
Okay, so here's the next question. So if the property needs work, should I still use this DSCR or go for fix and flip first?
So the first question I would say to person who asked me that, what is your intent with the property? Are you looking to keep this property as a long-term investment, or are you looking to have this property short-term, long-term or short-term? So if you're gonna do a fix and flip, meaning, hey, I totally plan on selling this property right after the renovations, which, by the way, I had a client do that. And in reality, they now refinancing because they want to keep it because they realize the rent is pretty substantial compared to what the payment is. And the property did not really need as much fixing. So they did a fix and flip. And now we are refinancing into a longer term with a better interest rate and better payment. So question is, do I need to have, if the property needs some fixing? DSCR is an option. There are some loans that we can do with renovation, and that might be if you long-term is to go ahead and keep the property, is going straight that way. But fix and flip is sometimes a quicker way, depending also of the extent of the repairs, because some repairs could be cosmetic that you can handle yourself, maybe with doing the line of credit, and some repairs can actually be where we need this to be able to be approved. So it depends on the intent, and it also depends on the actual type of repairs needed for this property to pass the appraisal. Awesome question. What else do we have?
Okay, so we also have here frequently asked from investors. Can I buy, renovate, and then refinance into a DSCR loan?
Yes. So you can definitely, it goes to what I just referred a little bit about the fix and flip, where we're looking at the return on the investment of fixing the property, not so much a DSCR. Is this property going to give us a good return once you do those improvements? And then now you are refinancing it to keep it long-term into using a DSCR. And honestly, this is exactly the way that I'm doing with Glenda and Steven, where the property was needing some potential repairs. They got their fix and flip, and now we are refinancing because this is a property that they feel like it's been. They actually found a buyer for it, but they're not ready to qualify. So that buyer is actually doing a lease purchase, but to keep the property with better terms, Glenda is basically refinancing into a DSCR loan. That's exactly the scenario that we have right now. What's the next question?
Okay, so I already own a home. Can I use my equity to buy an investment property?
Yes, definitely doing a lot of those right now, where people have a lot of equity with a low interest rate on their first mortgage. So we're not touching the first mortgage. A lot of clients still ask me, but I don't want to touch the first mortgage. You don't have to. We can go ahead and do a line of credit. Just have to look at the numbers, of course. Whenever you speak investment, now you are speaking about numbers, not just the emotional aspect of it. Numbers. Are the numbers making sense? When I take this line of credit for my 15 to 20% down, and then I am purchasing the next property, you can actually buy two ways that I could set this up for you. You can keep the current property as an investment. So you are getting your line of credit. We are getting the money for it. So you can have your down payment for the next purchase. And this property that you own currently, you know what? It's pretty good cash flow because you have a low interest rate on the first mortgage. You're getting a line of credit. Payment is low. Good return on the rental. Keep this property as a rental property. And then move and purchase your next home as owner occupied. Rate is higher right now than maybe your 3%. So let's say it's almost double. You know you can refinance when the rates get better for that property as owner occupied. You're having great return on that current residence, which you can take that cash flow positive and apply it towards your the payment on the next home. That's one scenario. Another scenario you can have is I totally love my house. I just want to invest in real estate, which is more of what Irene asked as far as a question. But you take the equity and now you are investing into more properties. Have a client who's basically using the equity in their home right now. The HELOC is helping him take the money, invest into a fix and flip. Okay. Sell this property. We get the money back with some profit, and then waiting for the next property. So there's so much you can do using the equity in your home. And a line of credit is great as your own bank. You don't have to keep on accessing, getting another loan. You just reuse it. You have 5 years. So let's talk about that because it's a very good tool to invest in real estate. I think we have a couple more questions.
Yeah, we have 2 more.
Awesome.
All right. So, should I sell my current home first or buy the next one before selling?
Should I sell my current home first or buy the next home before selling? So there are options. It depends. If you're able to sell your house, let's say you don't have kids in the house, it's just you, it's okay to just go ahead and easy put the house on the market, stage it every time, and sell it. You get more of your profit up front, right? You can go ahead and sell it, get your money, and purchase your next home back to back. Meaning, I'm selling, I'm under contract, I'm closing this Friday in the morning on the sale. The attorney takes the money, wires for my next purchase, and now you are buying the next home. But then let's say you have a family, you have pets, and you can't do all that. You're not able to really move the house on the market to sell. Then we can do a few bridge loan options where basically we are taking that money that you have equity in with a guaranteed offer from them. You can still sell your house so you can make the maximum profit. But for right now, you don't have the pressure of, I got to sell my house. You have a guaranteed offer that will allow us to not count the debt against you to qualify for the next purchase. So that is my bridge program, which remove contingencies also when you are looking to make an offer. Because right now, when there are competitive offers, contingencies get in the backside versus one that has no contingency. All right, let's close out with our last question. What is it?
All right, so this is the last question. How many
Mhm.
properties can I realistically build using these strategies?
So I'm not going to say infinite because it depends on your scenario, right? Depends on your assets, depends on how much you can actually have available as a down payment. But if money is not of the issue, let's say, as far as I can go ahead and generate more to have as a down payment, like I said, using the HELOC as a strategy to utilize over and over, it's infinite. There are Fannie Mae and Freddie Mac may have limitations of about 10 properties, but when it comes to the DSCR with our investors, you don't have that limitation. So if you are looking to invest in real estate, there are ways like house hacking, using your current house, renting rooms, renting a basement, having an ADU. You can do I love income producing properties. That's why I'm really passionate about this topic. You can also do the HELOC strategy, okay, using the equity in your home and now have a return. Yes, I'm getting into a debt, but as long as you're reinvesting that money, it's a great way because now you have more money coming in as cash flow. You can also use your HELOC to say, you know what, I do not want to be a landlord. I am not made to be a landlord, but I do want to invest in real estate, find some great deals, fix them, and then sell them. It doesn't have to be a tear down and rebuild. It could be something that's cosmetic. I have clients who find great deals right now that are people because they just need to go ahead and sell because it's an inheritance and it's gone through probate court and they just don't want to go through the whole process of fixing to make it pretty to sell. Investors are fighting those. People who are going through divorce, they have the pressure, they need to go ahead and sell. So there are circumstances. It's not so much I'm taking advantage of. You don't think of it as, hey, I'm an investor, I'm taking advantage of. There are opportunities. Jump on those opportunities, but you got to be ready. You got to have your numbers ready. You got to have your money ready. So this is where I come into the picture. I come and listen to your goal. How can I help you best? Be ready for what your goals are asking you to be ready for. Credit wise, you want to have strong credit. We can go as low as maybe 620 on some of those deals, but you don't get the best term. That means more down payment. So you want to be stronger with over 680 credit score, over 700 helps you leverage what is available right now. So this was helpful. Put any other questions that you may have regarding those programs so we can come and share about them. So Irene, thank you so much for being my interviewer today, asking questions so we can get more information that is valuable to you. Now we're going to hop as my guest speaker, Latoya is now here to go into my mystical Christelle energy talk, spiritual talk, but it's on a different YouTube. So join us there.